This is how people normally find support and resistance. They pick the line tool, draw an entry line, and place a stop loss few pips away. As you can see, it ends up hitting the stop loss. A winning trade turned into a loss. So, is there a better way? Yes, we are going to use areas, and we are only going to enter a trade when the trade is exiting out of these areas. Let me show you how to do it. But first, we need to understand what is support and resistance. They are significant price levels. When a trend is expected to pause due to the higher number of buyers and sellers' interest, the support area is formed when a downtrend is paused due to the concentration of buyers, meaning that more buyers came into the market compared to the sellers. The same way, resistance is formed when an uptrend is paused due to the concentration of sellers. So why we should draw these areas? We draw these areas beforehand in order to enter profitable trades because the strong support and resistance areas can increase the chance of entering a profitable trade. And to draw these areas, we should follow a selection criteria, which I'm going to demonstrate to you right now. Our goal is to enter in a profitable trade, and we can do it by avoiding a weak entry, which I'm also going to cover later in this video. Let's start with the strong areas. The first one is multiple rejections. More than 2 rejections are better. This is a great example of a support area, as the price jumped out of the area several times, giving multiple opportunities in return. The second one is resistance turned into a support. The price broke above this strong resistance because it had multiple rejections, and after that it worked as a valid support area. And the third one is recent price rejections. A recent price rejection is only valid when the price had moved away after the rejection. Now let's discuss the weak support and resistance areas. They are usually formed because of certain news or in unexpected economic events. The first weak area is extreme high. The second weak area is drastic move away. Remember, we can increase the chance of winning by avoiding wrong entries. Now let's analyze the trade entry using our selection criteria. Our first scenario is multiple rejections. As you can see, price came back to this resistance area and then went down, which allowed us to catch multiple trade opportunities. Let's learn how to draw these areas. We are going to use a free indicator which is called average true range or ATR. You can draw these areas on any platform with the help of ATR indicator. It can be found under the list of indicators by the acronym of ATR. Once you edit the indicator, draw a first resistance line touching the bodies of maximum candles. Then we have to find the biggest candle near the resistance line. Simply hover your mouse over that big candle and then look at the left bottom side at the ATR score and note it down somewhere. In our case, the big candle was this red candle. Now to calculate, we will look at the price value of our first line and add the ATR value which we already had noted down by hovering over the biggest candle. Please note that the ATR value will change if you move your mouse away to another candle. By adding that value of ATR, we have managed to get our second line of resistance. And in between these two lines is our area of resistance. Let's run this test. Remember, we're only going to enter a trade when the price is going out of the area. Let's apply these to other setups. Resistance turned into a support. As you can see, price was rejected several times near this area in the past, and when the price broke above this area, it is acting as a strong support. A similar setup is formed when a support turned into a resistance. The next setup, recent price rejections. So why are the recent price rejections so important? The recent price rejections are important because the traders are eyeing on this setup to enter into a profitable trade again. But it is important that you only enter a trade when it is exiting out of these areas. Let's discuss weak area of support and resistance. The first one is extreme high or extreme low. As you can see, price came to extreme high, but it reversed and never reached the resistance area again. Drastic move away. This is quite similar to the previous one, but it has one difference. The price reached to the extreme high and reversed, but it has broken down the multiple support area as well, which is a clear sign of a weak support and resistance. So why they are weak areas? We call them weak areas because they are usually formed due to the unexpected central bank's policies, bad or good economic news. In most cases, the institutions are involved to push down the price and clear the liquidity. We will discuss the institution candles in our future videos.